back on morning movers. Shares of Alphabet dropped more than 7% in trading yesterday. It's largely daily decrease since October 2023 due to an Apple executive testifying that AI products are taking market share away from traditional search. Now, after yesterday's move lower, Morgan Stanley staying bullish. The firm believes this presents a, quote, strong buying opportunity with sentiment at a trough. Morgan Stanley has an overweight rating on Alphabet with a $185 price target. Time now for Options Corner. Joining us to take a deeper look at Alphabet is Rick Ducat, lead market technician. All right, Rick, let's talk about the trends that you're seeing on the chart.
Alphabet has suffered a worse fate so far than its communications sector and the broader market, especially with yesterday's very rough nosedive here. So down about 10.6% on the year versus the S&P is up 8.5%. If we were to look more specifically at our candle chart, the price action lately has been probably a pretty big disappointment for the bullish crowd. We had our breakout to the upside from this downward sloping channel type shape between our two white dashed lines. However, even though we pushed above the trend line, we really struggled to take out those previous highs right here near 162. And ultimately, the orange 63-day exponential moving average was too much to overcome for the bulls in this case. We have retreated and we have now retested that old trend line. So old resistance has become new support around the 152 level or so. One key point to watch heading into today's trading activity, if we were to move lower, move back within the confines of this channel, the old lows near 140.53 would perhaps be the next point to keep an eye on there.
And then, Rick, what did you notice about any either unusual options activity or just overall volume recently?
When we look at our volume profile study, we can see that the area at which price was stonewalled has some extra emphasis here. It happens to be also our volume profile point of control, the area of heaviest trading on our chart here, near around 165. So an important rejection, an important upside level to watch. Notice as well that the place where price found some stability represents another, albeit much smaller volume node, but it still sticks out here relative to what's around it. Once again, though, so about 150, 165, those are some important boundaries to watch.
All right, thanks, Rick. And now to take us through an example trade, we've got Tom White, senior options contributor, co-host of Fast the Market. So, Tom, how would you structure or set up an example trade for Alphabet, especially? So now you've got some more bullish support. You saw the big drop yesterday. How would you approach an example trade?
Yeah, you mentioned the Morgan Stanley note. They said time to buy this stock. Evercore ISI came out. JP Morgan came out. All said buy this dip that we saw of over 7% yesterday in the session based on the back of that news that came out. So I looked at a pretty straightforward strategy that's bullish. If you think this thing's going to continue to rebound, the stock's up near 155 today, so up about 2%, so rebounding a little bit. This takes advantage of it, but we're going to give ourselves a little bit of duration for that to happen and offset some of the costs. So went out to the June monthly cycle, so 43 days to expiration on this this trade, where we're going to buy the at-the-money 155 strike call, and then against it to offset some of those costs, we're going to sell the 170 strike call. So the idea here is you want the stock to continue to rebound and go up to 170, and that's max profitability on this spread, as opposed to just buying the 155 strike calls, which will cost you a lot more money and take that break even up. If you pay a debit of around $5 on that spread, that's going to be your risk, $500 per spread. It can expand to $1,500, right? So you have that chance to make $1,000 on that. Takes your break even up to 160. That's just over 3% above the current share price in there. So you don't need a monster move. You just need that grind higher. You're giving yourself basically a month and a half in this position. Implied volatility levels are down a little bit today, so that will lower the entry point price on this bullish strategy. But the key here is, hey, you expect it to rebound. You're not going to have an earnings event within this time frame either. So if you expect this thing to continue to grind higher, go back towards 170, because the stock is still in bear market territory, down about 24-25% from those all-time highs. This takes advantage of a pretty straightforward bullish call vertical.
Yeah, look, it's been part of that pressure that we've seen on the Mag 7 this year. That's an example trade for Alphabet. Thank you, Tom.
Thanks.